Michael Barr, one of the bigger regulators in the United States, he's the vice chair of the banking system here in America. He gave a speech today at a college about cryptocurrency and what he sees. There's a lot of really interesting information in this. It's really good that we have regulators talking to regular people like college students about crypto and what they see and why they hold it. What are they doing with it? There's some bad takeaways and there's some good takeaways from the speech. I'll let you be the judge, but I just want to show you who this guy is. So Biden to nominate Michael Barr as top Fed banking regulator. The reason this is important is because all of these banks want to be in crypto. They want to be custody. They want to be like, you know how you have your MetaMask or your Coinbase wallet or whatever wallet it is, your bank wants to be that custodian of your. I think banks were a little late to the party in 2021 and 2020. And so they pushed back on crypto and they stalled it. And now banks had the time to catch back up. Now you have JP Morgan, going to have a wallet, Wells Fargo, Bank of America. All the bigger banks in America are creating crypto wallets so they can be custodians. And so when you have the top Fed banking regulator speaking about cryptocurrency, that is powerful. And we want to listen to what he's saying. I just want to show you some more information on this. Michael S. Barr took office as the vice chair of the supervision of the Board of Governors of the Federal Reserve System on July 19, 2022 for a 4-year term. He also serves as a member of the Board of Governors for an unexpired term ending in January 31st, 2032. Damn, that's a nice gig. It's like a 10-year gig. I love it. I said prior to this appointment of the board, Mr. Barr was the Joan of Sanford Wheel Dean of Gerald Ford School for Public Policy. That is a lot to say in one sentence. The Frank Murphy Collegiate Professor in Public Policy of the Roy F. and Jean Humphrey Profit Professor. This guy's done a lot of stuff, okay? There's a lot of stuff here. Let's get into the comments and what he said, and we'll talk about it as we go, okay? So here he is, Michael Barr. This is today, March 9th, 2023.
To talk about financial inclusion and community development. And I spent a morning talking with a group of college students. When I asked, it turned out that most of the students I met owned some crypto assets.
Of course.
This surprised me because in my experience as a professor, most college students are usually strapped for cash. What didn't surprise me is that many of those who said they owned crypto assets also said that they had lost money, and they weren't very happy about that.
Guys, understand that crypto is a new ecosystem, right? When you're a billionaire and you're investing into startup companies, right? You would be lucky if 1 or 2 out of 10 make it and you're able to recoup your investment, right? That's really the percentage of what these big guys look for when they look for wins. If they can win 10 or 20% of the time, it'll make up for the 80 or 90% time that they're losing. And with crypto, it's the same thing. You're investing in new technology. Not everything is going to make it. That's why you got to understand what you're investing in, do that research so you can feel more confident about your positions.
It was a reminder to me that crypto assets aren't just held by people with ample money for speculation. 1/5 of Americans, many of them with limited savings, say they have owned some form of crypto. The problems that have come to light in the crypto sector over the past year may have affected a large segment of the public. When I think about how to approach crypto assets, the technology behind them, and the interaction between the crypto sector and the traditional financial system, I find it helpful to place recent innovations in historical context. Innovation in financial markets has long raised questions about the appropriate role of regulation. Of particular concern is how the regulatory framework can serve both to encourage innovation and to support the safety and soundness of financial institutions and broader financial stability.
It's all about the financial institutions and broader stability. No mistake, guys. The banks are still going to win at the end of this. I know crypto is very libertarian. We don't need the banks. We don't need intermediaries, but they are going to grasp on. They've already grasped onto crypto, and they're not going to claw off, because if banks don't adopt the technology, they won't be banks much longer. That's true story, end of story, right? That's why JP Morgan's been in crypto since 2014, but what's his name? Jamie Dimon goes around saying crypto is for pet rocks. They're adopting blockchain, but crypto's bad. You see the thing here, guys? You see the difference?
Just as important is the need to protect the public from fraud and other abusive behavior. The challenge here begins with a mismatch in timing. Innovation often comes quickly, but it takes time for consumers to become aware that they could both gain and lose money on new financial products. It may take time for market participants to understand attendant risks and come up with tools to manage them. Likewise, regulation involves a deliberative process, as it should, because it needs to balance the risk that overregulation will stifle innovation with the risk that underregulation will allow for substantial harm to households and the financial system. Long before crypto became an issue for regulation and public policy, I was grappling with how to think about the cycle of innovation in the context of the global financial crisis. New products often develop slowly at first, while market participants are unsure of their value or risks. But excitement and enthusiasm can then lead to rapid growth, and new products flood the market as a result. Participants assume too quickly that they know how the new products work, and novel products can appear both safe and lucrative, particularly if they have not been tested through bouts of market stress. The innovation cycle then turns when this mismatch between perceived understanding of risk and actual underlying risk becomes apparent. Back then, I was talking about some of the causes and consequences of the global financial crisis. At that time, new types of financial products had become so intertwined with the banking and broader financial system that the turn in the innovation cycle resulted in devastating consequences for homeowners, workers, businesses, and the economy. Today, while the crypto asset sector is more nascent and less pervasive, the questions about how new financial products will affect the public, the economy, and financial stability are similar. Innovation surges ahead and regulation follows, trying to balance benefits and risks. Before I get into how we're responding to developments in the crypto sector in our approach to supervision and regulation, I want to recognize the potential public benefits of the technologies underlying crypto assets. It is often argued that these technologies will have extensive beneficial application beyond the crypto assets themselves.
They do.
The payment system is critical to everyday Americans. It is highly resilient.
The payment system, guys, this is why I focus on what is going to be used in the new payment system in my community. I hammer it down, and I hammer it down on this channel. All this information I give you guys is free research that I've done myself in the past four to 4.5 years. This is all I do 10 hours a day, 12 hours a day is research crypto. So I try to give you the most and best information that I see. Of course, I am not a financial advisor. I am just someone sharing my journey on the crypto revolution ride. But let's get back into this because he's getting into banking.
But also can be slow and expensive.
Payments.
This is particularly true with respect to cross-border payments. The technology underlying crypto assets, including that which enables programmability, could bring new functionality or efficiencies to payment systems. Proponents also claim that distributed ledger technology, encryption, and new ways of validating transactions could be used to facilitate faster reconciliation.
See, like he's talking about claim, like this could happen, right? This guy knows for sure what is happening with the US FedNow payment system. That is going to a 24/7, 365 payment system. How do you think they're going to do that? What technology do you think they're going to use to do that? They're going to use the new banking rails.
Clearing and settlement, and reduce costs for a variety of traditional asset transactions, including, for example, by linking securities and cash markets in ways that are more difficult to achieve under our current financial infrastructure.
True.
Use of smart contracts could automate certain actions, creating further efficiencies. Such use of the technology could lead to potential operational efficiencies and reduced costs.
Already happening.
The Federal Reserve has dedicated considerable resources to exploring and understanding these technologies and their potential benefits.
See, he knows.
As well as the risks associated with these innovations. In contrast to the potential benefits of these technologies, there is the actual experience of the many people whose hope and enthusiasm for crypto assets have met with disappointment and sometimes devastating loss. Robert Shiller describes how Bitcoin is a prime example of what he calls a contagious economic narrative. The story of Bitcoin's value proposition taps into the fears of government control and with the promise that, through superior technology, a new product can yield untold riches. But when it comes to certain crypto assets, some of which have no intrinsic value beyond the faith of their owners.
He is talking about Bitcoin right there, guys. Understand that. He is talking about Bitcoin and a lot of the crypto industry, okay? The value in Bitcoin is really the value of the people holding it, right? It doesn't have utility. It will not be used for international payments. Banks cannot use Bitcoin. Okay. Reason being is it doesn't have an anti-money laundering or counter-terrorism flags or KYC, know your customer. It doesn't have any of that stuff. That's why it cannot be used in the financial system. It has to have all of those things to work.
The law of gravity will eventually apply, as it did with the tulip frenzy in
The law of gravity will apply. He's basically telling you that these cryptocurrencies that don't have intrinsic value will eventually go to zero. That is exactly what he just said right there.
Holland more than 400 years ago. Experience has shown that crypto assets can face the same fundamental liquidity and credit risks as traditional assets and can be highly correlated with other traditional risks rather than being hedges against such risks. While purveyors of crypto assets have represented to customers that they are protected through the decentralized nature of the underlying technology, customers are often at a greater risk because those purveyors find ways to function outside of a robust supervisory and regulatory.
So when there's not rules or regulatory clarity, people do what they need to do to push their business forward. And some people, we saw a lot of it last year, are fraudsters and do things that they're there to make money for themselves. They're not there to help anybody else. And I really wish regulators like Mr. Barr here would be talking with more people about regulatory clarity so companies don't play outside of the lines.
Regulatory system. In the absence of regulatory compliance, customers don't have the information they need to assess and mitigate their risks. Investors do not have the structural protections they have relied on for so many decades. As a result, many have been victims of classic cases of fraud and abuse, some appropriately classified as Ponzi schemes under a high-tech veneer.
I've lost money.
Moreover, while crypto assets are hyped as decentralized, there has been an emergence of new, quite centralized intermediaries that are either not subject to or not compliant with appropriate regulation and supervision, which has perpetuated harm to consumers. Complicating matters further, these entities often seek out jurisdictions with loose or less developed legal and regulatory frameworks for financial activities. And the lack of consolidated home country supervision and coordination.
Say what? Come on, internet. All right, we're going to have to cut this out. The fudge muffins. Come on, Mr. Barr. We're not done talking. What? Did the tweet get deleted as I was playing it? What?
And community to regulate quite centralized intermediaries.
Sorry about that, guys. And we're back.
Supervision and coordination with host country supervisors rekindles the kind of abuses that bank regulators long ago quashed. While such cross-jurisdictional regulatory arbitrage is not new, the digital nature of these activities provides for greater opportunity to expand the reach of such entities to customers around the world. For example, the prominent collapse of the FTX crypto asset trading platform has reportedly wiped out the holdings of 1 million people, costing them billions of dollars.
Just to be clear, the FTX collapse and everything else that happened last year with 3 Arrows, Celsius, BlockFi, those are all examples of people borrowing money. They're trying to play the market. They lost, fraud everywhere. That's what he's talking about right here. And no, it's not the technology. It was the actors that were involved. People are bad. The technology is not bad, okay?
Unfortunately, this is not the only example. Since last summer, we saw the collapse of one crypto intermediary after another. As these cases are working their way through the bankruptcy courts, we're seeing indications of misuse of client funds, misrepresentations, obfuscation about the availability of deposit insurance, and potential fraud. Crypto has also been implicated in numerous cases of illicit financing. Crypto assets pose significant money laundering and terrorist financing risks due to the synonymous actors that are parties to transactions, the ease and speed of transfer, and the general irrevocability of transactions, all of which make crypto assets attractive for use in money laundering and terrorist financing. Indeed, enforcement agencies, including the Financial Crimes Enforcement Network, the Office of Foreign Assets Control, and the Department of Justice, have taken numerous public enforcement actions against entities or individuals dealing in crypto assets. This kind of behavior can cause substantial harm to investors and consumers, as well as our financial system. The federal bank regulatory agencies, including the Federal Reserve Board, have a statutory responsibility to ensure that the activity of the entities we supervise is conducted in a safe and sound manner and in compliance with all applicable laws. While the effects of the events in the crypto sector on Federal Reserve supervised banks have been limited in the aggregate thus far, recent experience has made it clear that crypto could pose risks to those banks. In response, we have worked with the other federal bank regulatory agencies to provide clarity and guidance on what is permissible, safe and sound, and compliant with anti-money laundering and anti-terrorist financing laws, as well as consumer and investor protections. And we've set out our supervisory expectations for banks engaging with new product types and activities. As noted above, this is not just a domestic issue. We're also working with our international counterparts to minimize the possibility of regulatory arbitrage across jurisdictions. One overarching principle of the Federal Reserve's financial oversight.
Guys, this has been Michael Barr. He's been talking to you about the crypto industry and what's going on. I thought this was powerful. It's today's news, and so I wanted to bring it to you today. Probably won't get out until tomorrow, unfortunately, because of the time difference between my editor, Cass, but I hope this shines some light on kind of where the top banking regulator is mindset is and where they're heading. But I do think regulation is around the corner in the world. In the United States, we'll probably get there in 2024 or 2025. The world will get there in 2024. The UK will get there first in 2023. But it's just very exciting times in crypto, guys. We got to have losses before we can shrink down the market to the real utility and what's going on in crypto. And those are going to be the real winners in the end. And that's what I try to teach my community every day. You guys have a good one. Thank you so much for watching. I know this is a little bit longer of a video, but I hope it was helpful. Cheers. Bye.